People say the goal in real estate is to grow big, more units, more debt, more everything. But here's the truth I've learned after 22 years. Bigger isn't always better. In fact, the faster you grow, the more you can wreck your focus, your freedom, and even your life. In this episode, I'll show you two different ways people grow. One's like a rocket, one's like a skyscraper. One burns out and one lasts. Let's talk about how to grow smart, not just big. In case we haven't met yet, my name is Chad Carson, and a few years ago, I wrote a book called The Small and Mighty Real Estate Investor. In short, this book talks about how you don't have to have hundreds of rental properties in order to have financial freedom. You could have 2 properties, 3 properties, 10 properties, and that could be enough to give you an abundance of money, but more importantly, an abundance of time. And I stick by the ideas in this book, and if you're interested in that, definitely check it out. But in this video, I wanted to go to an objection a lot of people have given me about small and mighty idea. And the idea basically is, hey, if I don't want to stay small, I actually want to grow. And so staying small and mighty is kind of like playing it small personally. And what I want to point out is that you can actually grow as a small and mighty investor, but it's actually just a different way to grow. And so I think about it like this. There are 2 different ways to grow. You could be like a rocket style grow, which is basically fast and flashy. Or you could build a skyscraper, that type of growth, which is more slow and steady. Both get to really incredible heights, but they do it in a much different way. The rocket style growth is very much about speed. It's about leverage, as much leverage as possible. It's about you either make like wildly successful, you make it to the moon, or you crash and burn, which happens a lot when you launch rockets. And personally, it's a high stress and also a fragile way to build a business. That's why you crash and burn. On the other hand, building a skyscraper, which I put as more the small and mighty approach, is you start with a deep foundation. I once heard it was really interesting that if you want to build a tall skyscraper, you got to build a really deep and strong foundation. So personally, but also with the skills of a real estate investing business, the skills of finding properties, the skills of financing, like you actually have to build those skills in a really deep way. And it might take a little bit longer, right? It might be a slower style of growth, but that slow growth is more sustainable and stronger over the long run. So that's the idea of a skyscraper growth, but it's also, most importantly, it's built to last. So even if it takes a little bit longer in the beginning, you're not just building this thing to launch, you're actually building this thing so that it can last for 10 years, 20 years, 30 years, the rest of your life, which is what you want. If you get financial freedom, if you get this flexibility, if you get the options and the cash flow, you don't want it to burn out. You don't want it to risk of going backwards. And so that's what a skyscraper style growth is all about. And I want to give you a couple of examples of non-real estate businesses, but very famous businesses that I think you'll recognize that have done it in this way. So the business of Chick-fil-A, the chicken sandwich and the billboards that say eat more chicken, is a business that used the skyscraper method of growth that I think we can learn a lot from. So almost 80 years ago, 1946, they had one location. And today they have over 3,236 locations. Really impressive to me is they make over $7.5 million in revenue per location. That's almost twice as much as the average McDonald's store. They're the 3rd largest fast food restaurant in terms of sales or revenue, and they're only behind McDonald's and Starbucks, but they're closed 1 day a week. So they have that disadvantage as well. And they're America's favorite fast food restaurant in terms of the ratings. If you read some of the major ratings, through 2022 is the last one I saw, but they did it 8 years in a row. So very popular, very successful, very large, and fast growing at this point, like really, really making progress quickly and adding a lot of stores. But how did they do that? That's the key that we can learn from. Well, number one, they have a very small, simple menu. They focus on the things that work. The chicken sandwich hasn't changed for many, many years. They focus on customer service. Like they train people when you walk up, say, how may I serve you? And focus on the little things of cleanliness and how can they do good customer service. And they've done very deliberate growth. So if you study the history of Chick-fil-A, the first 10 to 20 years, they didn't have that like signature chicken sandwich everywhere that you see today. It took them some time to establish and to learn what works. It took them some time to build their systems and their processes. They didn't grow really fast with a bunch of restaurants right off the bat. It wasn't until a couple decades later, they started branching off into malls and had Chick-fil-A, the name Chick-fil-A. They had a different name before that. So the history you hear 80 years later is not always a fast start, like a rocket ship. This thing was a deep foundation of figuring out what works, keep it simple, customer service, and then growing deliberately with very little debt. And I don't know exactly the financial history of the company, but I know they don't use debt, or they have very little debt today, which is unusual for a fast growing company. They fund all the new restaurants from the profits that they make at the other restaurants. And they have a really interesting franchise model where they don't go out and sell the land to other people. They own the land and the buildings themselves. They have franchisees who get to share in the revenue, but don't have to pay a bunch of money to get in. So there's a lot of interesting ways they focus on a long-term mindset that pays off for them. And they basically, if you think about the skyscraper metaphor, they dug a really deep foundation in terms of what they wanted to stand for, how they wanted to do their business. They were focused on customer service, and then they built it floor by floor by floor, not in a hurry, just in a way that would last. And when you get to 2025 and you look at it compared to a lot of other businesses, fast food businesses that have flamed out, they've got an enormous foundation, a solid foundation that could hold a skyscraper that'll continue to go up many, many decades into the future. That's an incredible way to grow a business. Another example of a skyscraper style of business that I admire is Patagonia. It's an outdoor clothing company. It's founded in 1973 by Yvon Chouinard, and he was a climber and outdoors person. He actually had another business that he made climbing equipment even before then. And just as an aside, one of my favorite business books, which is kind of an unbusiness book, is Let My People Go Surfing, and is where Yvon Chouinard talks about his philosophy of business and some of the principles he built. But if you look fast forward from 1973 when it started to 2025, Patagonia is the number one outdoor apparel brand by market share, like really big, significant outdoor company. They make $1.5 billion per year. They have over 3,000 employees. 98% of the materials they use in their brand and their clothing is recycled. That's what I'm going to get to in a second. A big part of their mission is to have a low impact on the environment, which is kind of hard when you're growing and using off byproducts when you're making clothing. But the cool thing about their story, they're very different than Chick-fil-A in some ways. They have a different mission, a different founder, but the commonality they have is how they grew and the fact that, the mission they had a mission kind of behind the business. So in 1973, he actually started off by finding some rugby shirts for other climbers. He was looking for clothing that would be a good, like rock climbing clothing. And for whatever reason, these rugby shirts that he found a bunch of in England or somewhere, he brought those over and sold them in a little store next to his outdoor equipment store. And it grew from there, but it was very, very slow, kind of like Chick-fil-A. It was not something like shot out of a rocket ship. It was reinvest my profits, do things very lean and just kind of grow as you can. And they had intentional growth for many, many years and many decades, even up through today as well. They learned that even though when people wanted their products, the natural thing to do is just because you can grow, because you have the ability to grow, or because people pay you to grow, that you should grow. Like that was the assumption that he challenged, and a lot of other people building skyscraper type businesses do. They challenge that and say, well, I'm just going to keep at my pace and I'm going to grow organically because of some of the downsides, because I don't want to flame out. So they also used no debt. That's one of the commonalities you'll see with businesses like this. It's not that they always use no debt. Like in real estate, I like to use debt, but I'm very cautious with it. And I like to get out of debt in many ways and reduce the amount of debt over time. And so no debt, intentional growth, mission-oriented type style of business. There were even times where part of his mission was to make a low impact on the environment and help with the climate crisis. So the business of Patagonia would make moves like only using organic cotton that would cost them a lot of money in the short run. But they felt like it was the right thing to do, and it aligned with what the values were and it aligned with the values of their customers. And because they did that, it made them grow slower. They had to kind of take 3 steps back in order to take 4 steps forward. And that's a very common theme, long-term orientation with their finances, with their mission, with the pace of growth, with the way they sell things. And it's not going to guarantee you that you're going to be successful, but it's like when you're climbing a mountain. I always use that metaphor. If you take your time, you put one foot in front of the other, you're more likely to make it to the top. You might make a mistake. You might slip here and there, but you're going to be a lot more sturdy-footed than trying to sprint to the top of the mountain. And from a business standpoint, building a skyscraper, Patagonia and Chick-fil-A are really good examples of digging that foundation and just taking their time and building it. And they now both have very sustainable long-term businesses. Patagonia, what I just read about Yvon Chouinard was he passed on his shares in the company to a trust, essentially a nonprofit, that will control his shares forevermore so that the mission of the business can keep on going. So this is a super mini generation kind of legacy way to build a business. So, no, we're not building chicken sandwich businesses or selling outdoor clothing. We're buying real estate. We're building freedom with rental properties. And so, I want to show you how I would apply the principles of the skyscraper style of growth to real estate investing. And you can think about it as the small and mighty way. These are some of the main ideas I took from my book, The Small and Mighty Real Estate Investor. And probably the first one and most important one is that when you build a skyscraper type of business and you pace yourself with growth, you're focusing first and foremost on what matters to you. I mentioned that those were mission-driven businesses. I'm not saying that you have to have a particular mission in mind. There could be very different missions, but the reason we get in business is not just to make profits. Profits are great. It's kind of like the purpose of your body is not just to pump blood, right? It's very important that you pump blood. It's very important to make profits. But what's the purpose of a body? It's not to pump blood. It's to do other things. The purpose of your business, of your real estate investing business, is to serve your life, is to help you do what matters, whatever that means to you. For me, that's been traveling with my family, spending more time as a parent, is being more healthy, is traveling, is doing all sorts of stuff. That's what matters to me. You have things that matter to you. The business should serve that and not the other way around. And so growing more deliberately and also knowing when you have enough really helps you have a business that serves what matters instead of the other way around, where the business kind of controls everything else. It also means growing more like a tortoise than the hare. This is Aesop's old fable where the tortoise, slow turtle who's very persistent but not very fast, and the hare, which is a rabbit, runs really fast, go in a race, and the rabbit starts fast, but then it slows down and takes a nap, and then it starts fast again, and then something else happens. And the tortoise is still winning the race of business. This is a long-term endurance type of race to win in business. It's not just having the most units and buying the most properties in 1 year so you can put it on social media. It's, are you going to last? Are you going to build a deep foundation to have a skyscraper? And the tortoise is still winning that race. Number 3, and this one I think is very undersold, is underappreciated, is really about the craft of real estate investing. Staying small or growing more deliberately allows you to focus on excellence, allows you to focus on skills and quality. So the equivalent of, making that chicken sandwich, take 20 years to make that chicken sandwich really, really good. Well, it might take you a while to get good at finding properties. It might have to, the first deal, the second deal, the third deal, you get a little bit better at every one. I admire like mechanics, or I admire doctors or nurses or whoever, a janitor, somebody who does their job with excellence and does it really well. That's what we get to do as real estate investors. We get to treat our tenants really well, give them a good product. We get to treat our lenders and our money partners really well. We get to treat the people who sell us properties. It could be a win-win if we focus on the skill of being a real estate investor. Number 4, it's about people and relationships. I had a mentor one time who I was starting to grow a little bit and like really pushing it. This is 2007, the biggest growth year I had when I learned a lot of my lessons about what I wanted to be in business. And he came to me one time. His name's Dr. Stone. And I was thinking about buying more properties and getting more lenders. And he was one of the private lenders who loaned me money to buy properties. And he said, Chad, I'm sure you'll be successful doing that. But one of the things I admire about you, Chad, is you treat your small number of investors very well. You give us a lot of personal attention. You take care of us. You pay attention to the details. If you had 3 times more investors, is each investor going to get the same attention and get the same care that they're getting right now? And I had to think about that. I was like, probably not. And so I chose not to expand and get really big and focus on and kind of double down on the people and the relationships that I had and go deeper with those relationships with my lenders, with my tenants, with the people I'm meeting, the contractors, the vendors of my business. And you can do that when you grow more deliberately. Debt, we talked about that some. Debt is sometimes looked as a religion in real estate. Like paying off debt is like heresy, right? And it's just against the religion. Debt is just a tool. It's a great tool. I like using it. There's some people like Dave Ramsey's a big real estate investor. He doesn't want to use debt. He doesn't believe that's the right way to do it. I think it's okay to use it, but it's like you want to use it very carefully. I compare it to a power tool. If you're going to build a house, it's nice to have a power saw, right? Because you can build the house a lot faster and a lot more precision, but you got to be really careful with it because you can cut your finger off with a power saw. So I see debt that way too. Be careful with it and know when to put the tool back in the toolbox. You don't need it forever. At some point, you don't need to take the risk because you've already built enough wealth. You actually should probably start paying off debt and getting out of debt at that point. And then number 6, what does success actually mean? To a small and mighty investor, someone who's building it with a skyscraper type of model, it's not just the number of doors you have. It's not just how much, you can brag about how many units and how fast I'm growing. It's about how much freedom do you actually have and how much time do you have. I want to be a time billionaire. That was always my goal, because time is what life is made of. That's how you spend more time with your family and your friends. That's how you go on trips. Like we went for 17 months to Ecuador and we went for a year to Spain. You got to have free time. You got to have flexibility, and you got to redefine success and what it means for you. And that goes back to what matters to you as well. And then number 7, yes, you can grow. So I started this episode talking about those of you who are kind of ambivalent, or you're kind of, I don't know if I want to go stay small and mighty because I like to grow. I like to push it. Well, you can actually grow, and actually grow even better. You can build the biggest skyscraper around by being small and mighty, by being deliberate. So don't feel like it's a compromise. Don't feel like just because you start and focusing on craft and you're a little bit more of a tortoise that you can't grow. It's just how you grow and the pace of growth. I had someone tell me one time, there are no unreasonable goals. They're just unreasonable timelines. You can accomplish whatever you want, but you can't accomplish it whatever you want in really quickly. So that brings me to the main point of this episode, and it's simply a question. What are you actually building? So you're interested in real estate investing, you want to be an entrepreneur, but what are you trying to build, and how big are you trying to build it? And you could tell from this video and what I'm trying to talk about, I feel like what we're trying to do really is build a life, that our life is at the center of it. What matters to us is at the center. And so it really matters how you grow. And if you want to build an amazing life, you don't have to build a rocket ship. You don't have to go big. You don't have to 10x and do it the way that a lot of people talk about it in the real estate investing business. That's just one path. You can go through the skyscraper approach. And even if you don't want to build a skyscraper, maybe you just want to build a 3-story brick building that's beautiful and you're proud of it, and you have 5 properties and it pays for your lifestyle for the rest of your life. I think that's beautiful. Or maybe you want to build the biggest skyscraper in the world from a business standpoint. Either way, the approach of being slower and deliberate and the small and mighty approach to real estate investing, it can get you there. And the difference is you're focusing not on speed, you're focusing on staying power and on the lasting style of business. And so if you want to get more details about how to do this, I have a few recommendations for you. First of all, my book that I talked about earlier is kind of the handbook on how to do that. I also have a community called Rental Property Mastery where I spend most of my time. So if you want more coaching and feedback and help and accountability from other small and mighty investors, I have a community that is capped at 300 members. So it's also small and mighty. We're over 250 now. And so you can check that out. I have a link in the show description and the podcast description as well. And then the third thing, I have another video that I recommend that you watch that is how it's about the math of being a small and mighty investor and how you can actually have financial freedom with just 5 simple properties. So it's a short video, under 20 minutes, and you can watch it and figure out what it would look like, what the cash flow would look like, what the numbers would look like to have a small and mighty portfolio that can give you a time abundance and also pay all your bills that you need to pay for it in your life, so you can have a lot more flexibility and freedom. So check that out. I'll have a link or thumbnail above me here, or you can click on the link in the podcast or the YouTube description below. Thank you so much for watching. I hope it's been helpful, and I'll see you in the next episode.